All right, so let's break down exactly what is a real estate syndication, and then more importantly, how do you actually profit from a real estate syndication deal? And so in a typical real estate syndication, this is a partnership structure when we're going to take down bigger deals. And in this partnership, you have your general partnership, which again is the active operators, those who are putting together the deal, finding the financing, raising the capital, and then managing the deal going forward. You have your LP structure, which are the limited partners or the passive investors that we've been talking about. And in this structure, you have your GP, and typically in a partnership form, in a syndication deal, the GP owns anywhere from 15 to 40 or 50 really percent of the deal, right? And then the LP owns the lion's share, the majority of the deal, typically anywhere from 65 to 80% of the deal. So as an LP, you own the lion's share of the deal. Also in a real estate syndication deal, the way that I see these break up is that, so the limited partner also has a preferred return. So you're typically getting the first money that comes back from a deal. And so typically that's anywhere from 6 to 8% in the deal. So let's say from the cash flow, this also could be cumulative. So if we're not having enough cash flow in the deal, this gets rolled over into every year. So you're getting the lion's share of the deal. You're getting a preferred return in this thing. And you also as a partner, you're an owner in this deal. And so you're getting things like depreciation, which we talked about. You're getting cash flow. And you're getting appreciation, right? When we sell the deal, when we refinance, you're getting the upside. So we've talked about the LP, but in a real estate syndication, you also have a GP, and they are the ones who are actively managing the deal. And for that, there are typically some fees for that, for putting the deal together and for hitting hurdles to perform for the LP. And so typically whenever they close the deal, there's anywhere from a 2 to 3% acquisition fee of the purchase price. So on a $10 million deal, 2% of that's going to be a $200K acquisition fee that they get at closing. That comes from the raise of the deal. And then I've also seen what we call a waterfall split. And so once investors get a certain return back on their money, the GP is then entitled to their share of the real estate deal. And the reason I like a real estate syndication structure from a GP-LP standpoint is that it puts everyone in alignment, right? So the priority is like, how can we get returns back to investors so that the general partners can make money too? And by the way, if you're against GP making money, then you're against capitalism. And I think that this is why it's important, is that you're aligned with your investing team. When's the last time you went to your financial advisor and said, hey, you can get paid whenever I hit X amount on my portfolio? That's just not typically how the financial advising world works. But in a real estate syndication, everyone's aligned on the same goal. And that goal is to make as much as we can from a return standpoint so that everybody can share in the upside. So in recap, you have a GP-LP split. The LP typically owns the lion's share of the deal. They also have a preferred return. As an owner in the deal, you have all the benefits, depreciation, cash flow, and upside of a real estate deal. And then your GP, which is the owners, the operators of the deal, they own the other share of this real estate. They're taking fees for putting the deal together. And then once there's some type of hurdle, typically this, let's say it's a 85-15 split originally. Let's say once you get double your money back, this might go to a 60-40 split, where now the GP owns 40% and the LP owns 60%. Hope that helps.